Hi friends, welcome to my channel InfoCraze. Today we will prepare for some common job interview questions that are very important for the position of finance managers. If you are a finance student or a finance professional, it's very important that you are well prepared to answer these questions. Before proceeding further, let me request you to subscribe to my channel if not done yet, so that you do not miss out on my future videos. Now, let's get started. The first question we take up here is, what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation and amortization. EBITDA focuses on the profitability of a company's core business operations without considering the deductions for interest, taxes, depreciation and amortization. It is a financial metric used to evaluate a company's operating performance, often used as an alternative to net income. Let's check the formula for calculating EBITDA. Using net income, we can have the formula of EBITDA as EBITDA equal to net income plus taxes plus interest plus depreciation plus amortization. If we use operating income, then EBITDA equal to operating income plus depreciation plus amortization. As we know, operating income is basically the sum of net income, taxes and interest. In order to understand EBITDA properly, let's consider a sample income statement here which starts with revenue and ends with net income. As per the first formula, EBITDA is obtained by adding net income, taxes, interest and depreciation or amortization. Thus, by using net income of $8,400 from the sample income statement and adding back tax, interest and depreciation, we get the EBITDA as $12,500. From the same income statement, we calculate the operating income here, which is $12,200. Adding back the depreciation of $300, the EBITDA works out to $12,500, which is the same as calculated by us in the earlier method. By excluding the interest, taxes, depreciation and amortization, EBITDA focuses on the profitability of a company's core business operations. EBITDA provides a clearer picture of operational performance, making it an useful tool for comparing companies pertaining to the same industry. It should, however, be used along with other financial metrics to get a comprehensive view of a company's financial health and performance. The second question we discuss here is, what is cash flow? How is it different from EBITDA? The net amount of cash and cash equivalents transferred in and out of a business during a given period is referred to as the cash flow. A business transaction that leads to the increase of cash and its equivalents is called a cash inflow, whereas the one resulting a decrease of total cash and its equivalents is known as cash outflow. It is a measure of a company's net cash inflows and outflows, which is reported in a financial statement called the cash flow statement or the statement of cash flows. Cash flows are classified into three broad categories. Cash flows from operating activities, which is cash generated from a company's regular business operations. Then we have cash flows from investing activities, which is cash utilized for or generated from investments in assets such as the purchase or sale of property, equipment or securities. The last one is cash flows from financing activities. Cash generated from or utilized in financing activities such as borrowing or repaying debt, issuing stock or paying dividends. Let's consider the earlier sample income statement. Now, we will extend this statement to include sample data for showing the items captured in a statement for cash flows. We will start with the operating cash flow, which is a part of the cash flow statement that shows how much cash is generated or consumed by a business from its operating activities over a period of time. It is calculated by taking a company's net income and then adjusting for non-cash items like depreciation or amortization and accounting for the changes in working capital items. Thus, in our current sample statement, the cash flow from operating activities is working out to $8,800. Now let's extend the cash flow statement by including the items related to investing activities. This section of the cash flow statement shows how much money is made or spent by a business through its investing activities during a specific accounting period. These activities may include purchase or sale of non-current assets, that is, fixed and long-term assets like equipments, properties, factories, investments in marketable securities like stocks or bonds and acquisition of other companies. Next one in the cash flow statement is the cash flow from financing activities. Cash generated or spent on financing activities shows the net cash flows involved in funding the company's operations. Financing activities may include repayment of debt, issuance of shares or equity, payment of interest on debts, dividend payments, stock buyback, bond offerings that generate cash, etc. Cash flow is quite different from EBITDA. While EBITDA and cash flow both provide important financial metrics, but they serve different purposes and give different insights into a company's financial health. Let's review the basic differences between the two. EBITDA highlights the operational profitability of a company before the impact of financial decisions, tax environment, and accounting practices. Cash flow, on the other side, tracks the amount of cash being generated and utilized by a business, which is very crucial for reviewing financial liquidity. EBITDA does not account for the changes in working capital, focusing solely on earnings before interest, taxes, depreciation, and amortization. Cash flow accounts for the changes in working capital, reflecting real cash movement. EBITDA helps to ascertain the earning potential of a company. Cash flow shows how a company's earnings are actually being used, indicating available cash for paying debts and meeting business expenses. Next question that we discuss here is, what is free cash flow? Free cash flow represents the cash generated by a business after accounting for the cash outflows required to support its operations and capital expenditures. Formula for free cash flow is free cash flow equal to cash from operations minus capital expenditures. Thus, free cash flow shows the cash that a company can generate after deducting the purchase of assets such as property, equipment, and other investments from its operating cash flow. Let's take up the sample cash flow statement for operating activities. From the net cash flow of $8,800 from operating activities, if we deduct the capital expenditure of $700, we get the free cash flow of $8,100. Free cash flow gets its name from the fact that it's the amount of cash flow which is free, that is available for spending by the management or shareholders at their discretion. Next question is, what is free cash flow to equity? Free cash flow to equity is the amount of cash generated by a business that is potentially available for distribution among the shareholders. It represents the cash available to the equity shareholders after a company has met its financial obligations related to operating expenses, capital expenditures, and debt service costs, including interest and principal amounts. Free cash flow to equity, also called the levered cash flow, is calculated as cash flow from operations minus capital expenditures plus net debt issued minus debt repaid. Hope you have understood all the terms that we discussed today. All these terms are very important for people who are into the field of finance, either as a student or a professional. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Please subscribe to my channel for many more interesting videos in the field of finance, accounts, and costing. If you have any question, please leave your query in the comment section. Thanks for watching.